Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Key Financial Ratios Demystified for Smart Investors. Calculate the ratios. Once you have the financial statements, the next step is crunching the numbers. Each ratio tells part of the story, so using the right formulas is key. Here's how to calculate the main types of ratios. Liquidity ratios, e.g., current ratio, divide current assets by current liabilities to see short-term financial strength. Profitability ratios, e.g., return on assets, take net income and divide it by total assets to measure how well resources generate profit. Leverage ratios, e.g., debt to equity, divide total debt by shareholders' equity to evaluate risk and reliance on borrowed funds. Efficiency ratios, e.g., inventory turnover, divide cost of goods sold by average inventory to assess operational efficiency. Market ratios, e.g., price to earnings, divide the stock's market price by earnings per share to gauge investor expectations. Use a spreadsheet to organize the numbers and perform calculations. Many accounting platforms also have built-in tools to automate these steps, which can save time. If you're doing it manually, double-check your math. A small error can snowball into major misinterpretations. Interpreting the results. Numbers by themselves won't tell you much, it's all about context. After calculating the ratios, the next step is understanding what they mean for the business. Start by asking these questions. How does the company compare to industry standards? Look up benchmarks for the company's sector. For instance, a current ratio of 2.0 might be solid for a manufacturing firm but too low for a retailer. Is the trend improving or worsening over time? Compare the latest results to past periods. Consistently rising debt to equity ratios could signal overleveraging, while steady growth in ROE shows increased profitability. What are the outliers? Spotting unusual values can highlight red flags. For example, a very high P/E ratio might signal overvaluation, or it could mean the market expects rapid growth. Don't rely solely on one ratio. Combine insights from several categories to get a well-rounded view. For example, if liquidity ratios look strong but profitability ratios are weak, the company might be managing cash well but struggling to grow. Context, both within the financials and against external benchmarks, is everything. Limitations of ratio analysis. While ratio analysis is a valuable tool for understanding financial health, it's not without its flaws. Ratios offer insights, but context and understanding are just as important to avoid misleading conclusions. Let's explore a few key limitations. Context dependency. Financial ratios don't operate in a vacuum. They depend heavily on the industry, company size, and overall economic conditions. What's considered healthy in one sector might signal trouble in another. For example, a high debt-to-equity ratio might be normal for a capital-intensive industry like utilities, but it could raise red flags for a tech startup. Similarly, a low inventory turnover might suggest inefficiency for a retailer, yet for a luxury goods manufacturer, it could reflect a deliberate strategy to maintain exclusivity. Economic cycles also play a role. During an economic boom, solvency ratios might improve simply because revenues are rising across the board, not necessarily because of better management. On the flip side, in a downturn, even a well-managed company might see weaker ratios due to shrinking demand. This variability makes it crucial to compare ratios to industry benchmarks and broader economic trends. Without this context, interpreting the numbers correctly becomes nearly impossible. Instead of taking ratios at face value, think of them as part of a bigger puzzle. Historical data reliance. Ratios are calculated using historical financial data, but businesses operate in a forward-looking world. What worked well a year ago might not hold up today, especially in fast-changing markets. For instance, return on assets, ROA, from last year might look strong, but if the company recently invested heavily in new equipment, future returns could take time to materialize. Profitability ratios might be inflated due to a one-time event, like selling off an asset, which doesn't reflect ongoing operations. Another challenge is that past performance doesn't always predict future success. An economic recession, a change in consumer trends, or new regulations can all disrupt a company's trajectory, making historical data less relevant. Using ratios to forecast without considering these factors can lead to unrealistic expectations. Relying too much on backward-looking data is like driving while only looking in the rearview mirror. It might give you a sense of where you've been, but it won't help you see what's ahead. Combine ratio analysis with real-time data and future projections for a more accurate picture. Real-world applications of ratio analysis. Ratio analysis isn't just a theoretical exercise, it's a practical tool used by professionals across industries to make informed financial decisions. From deciding where to invest to evaluating creditworthiness, the insights gained from ratios play a key role in shaping strategies and mitigating risks. Investment decisions. Investors rely heavily on ratio analysis to decide where to put their money. Stocks, bonds, startups, every investment comes with its own level of risk and potential reward. Ratios give investors a way to compare options objectively. By slicing through the noise of financial statements, they can identify which opportunities are worth pursuing. Here are a few ways investors use ratio analysis. Assessing profitability. Metrics like return on equity, ROE, and earnings per share, EPS, help determine whether a company is efficiently generating profits from its resources. Consistently strong profitability ratios can signal that the business has a solid track record of success. Measuring valuation. Ratios such as the price-to-earnings, P/E, ratio show whether a stock might be overvalued or undervalued. For example, a low P/E ratio could indicate a bargain, or a company in trouble. Evaluating risk. Leverage ratios like debt to equity tell whether a company relies too much on borrowing. A high level of debt may scare off cautious investors, especially if the business isn't highly profitable. Comparing competitors. Ratios allow apples-to-apples comparisons within an industry. For instance, a retailer with a higher inventory turnover than its peers may have superior inventory management. Without these tools, separating good investments from bad ones becomes a guessing game. Ratio analysis empowers investors to make smarter, numbers-backed decisions. Credit evaluations. For lenders, ratio analysis is a go-to method for gauging whether someone, or a business, is a safe credit risk. Giving a loan isn't just about trust, it's about assessing a borrower's ability to pay back the money on time. That's where these ratios shine. Lenders typically focus on these areas. Liquidity. Does the borrower have enough short-term assets to cover their short-term liabilities? Ratios like the current ratio and quick ratio are used to answer this question. If the numbers are low, it could mean trouble making payments in the near term. Leverage. How much of the company's operations are funded by debt? The debt-to-equity ratio and interest coverage ratio give lenders an idea of how risky the borrower's financial structure is. A low interest coverage ratio, for example, might suggest that a business is struggling to meet its debt obligations. Profitability. While liquidity and leverage focus on resources and risk, profitability ratios provide reassurance that the borrower is making enough money to sustain itself. Healthy profit margins signal that cash flow isn't an issue. Lenders aren't just crunching numbers, they're predicting future behavior. A company with weak liquidity or high debt might be a risk for defaults. By analyzing ratios, lenders can approve loans for those who are likely to repay and set terms that reflect the level of risk. In both investing and lending, ratio analysis turns abstract financial statements into actionable insights. It provides clarity, helping professionals avoid pitfalls and seize opportunities with confidence. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.